I'm very excited to be talking to you guys today. And what we're going to do is talk mostly about pinning because guess what? We are at that time of the month. Well, not that time of the month, but at the time of the month where I still prefer to do the monthly pins. The weekly pins are starting to gain some traction, but I do like the monthly pinning process. And let me double check. You should see a chart of Apple. It happens to be a 144 tick chart, but I just want to make sure you guys can see that. All right. And is it pretty clear? You guys can see it okay? I like this GoToWebinar. It works pretty clean. Sometimes the last couple of times with Omnovia, I've had some issues with it, so this is pretty good. So quick survey. I just want to just so you guys let me know how many people here have done pinning on options before. Or let me ask this: how many people here have never done pinning on options? Okay, so a lot of you guys have never done it. All right, looks like about half and half. And you know, people always ask me two questions. They're like, well, they ask me actually a lot of questions, but one of the questions that comes up a lot is, you know, what's your favorite setup? You can only do one setup. What's your favorite setup? And part of me, honestly, I kind of have to laugh at it because, you know, of course, these are people who aren't willing to do the work. You know, they're looking for the Holy Grail. So, you know, what's the one setup that works the best? And of course, the truth is that, you know, when you got to use things like the waves and stuff like that to get the trend, it's like, well, you know, squeeze longs work best when the C wave's above zero, right? Squeeze shorts work best when the C wave's below zero. I mean, those are, but you know, there's things. So it's not like squeezes work the best. It's da-na-na-na-na-na. Well, one of the trade setups I've seen work the best, and it's been profitable 13 out of the last 14 monthly options expirations, has been pinning. And so if it came down to like, gosh, if there's only one, you know, if I was like, you know, kind of retired a little bit, and there's only like one strategy I could focus on, it really would just be pinning options. It's very clean. It's, you know, it's easy to do once you understand it, and there's a lot of market forces at work to make it happen as well, because when you're doing pinning, you're trading on the side of the funds, and that's the side that you want to be on, all right? And there are, hey CB, there are also the concept of the premium decay is pretty awesome too. So what we're going to talk about is, because we've got some time, is we're going to talk, I'll share a little bit, just kind of some basic slides on how it works, because the reality of it is that you really got to look at live data to understand this. But I think it's good to kind of get a little bit of a, you know, kind of a primer, so to speak. So I'm going to show you, we're going to do basics. What I call it options 101, but I do this in 5 minutes, okay? So for those of you that are experienced option traders, because anytime, I mean, obviously I'm an experienced options trader, and anytime somebody starts showing me basics, I just like going, oh my God, kill me. This will be extremely short, and it'll actually help, kind of helpful too. So what we're going to talk about, I'm not even going to tell you what a call and a put is. I'm not going to tell you that. I'm not going to tell you that. When you get into options trading, there's a couple of reasons why a lot of people get hosed doing it. First of all, why is it attractive? Because you get the same leverage as you would trading futures, but you're only risking a fixed amount of money, okay? In futures, it's more about margin, right? Yeah, and I'll get you guys this presentation. And a good example is trading silver futures. You know, it wasn't that long ago when you only needed $5,000 margin to buy a futures contract, and now it's like $30,000. So the margin is kind of flexible, and you could actually get yanked out of position if your margin isn't enough, right? Which I think is pretty lame. The other thing with futures is that you're not, when you put up margin of say $5,000 to buy a contract, that really doesn't matter. And by the way, I'm not knocking futures. I trade futures all the time. I just want to compare futures and options. But think about it, on margin on futures, if futures have a horrendous move overnight, for example, grain futures gap against you 4 days in a row, there's nothing you can do in your account could go debit forever. I mean, I know a guy that had a $30,000 account, and he went debit $250,000 because he was way, way over leveraged in wheat. One contract for $30,000. Okay, that's okay for day trading. That's actually still too aggressive for day trading, I think. But he held it overnight like a moron. I mean, that's his own damn fault for doing that. And it gapped up against him like limit, like he held it into the non-farm payroll report. So that was, I mean, not the crop report. And he woke up the next day and he was debit, $250,000. And, that's his own fault. Okay, there's two reasons why that should actually never happen. One, if you're semi-educated, you're going to sit there and you learned about futures, you're going to sit there and go, well, 30 contracts in a $30,000 account is way too much, and you don't hold into a non-farm payroll report. Okay, so that's just common sense, and he decided to roll the dice and he got hosed. The nice thing about options is you could actually have done that same trade with options, and you could have bought, say, an out-of-the-money soybean call. And, if it would have been a disaster, or wheat call or whatever, if it would have been a disaster, you would have risked the premium, and that's it. So that's one of the nice things about options is you got a fixed amount that you can risk. So what I find, though, and what we're going to talk about here is how important implied volatility is, and we're going to get there in a second. And what happens is most people, and this is going to be mostly on stocks. So let's use Apple as an example. But say intraday, somebody's watching Apple and it's at $340, and man, there's some buyers coming in, and Apple's rallying, it's rallying and rallying, and now it's at $344. It's like, my God, I got to buy some calls on this. So I'm going to buy some of the $350 out of the money calls. Well, there's a couple things here and that's a common thing that people do, and a couple things here that are just, you're screwed from the get-go. One, buying out of the money calls is actually not the devil's work. Okay, I reference that because Hubert's got some great great references about trading options. It's the devil's work. It is the devil's work if you buy out of the money options chasing a stock like that. And it is because, option prices can be manipulated, like they can move even though the underlying isn't moving. So there are a lot of squirrely things that go on in options. I just took a sip of my veggie fruit whey protein shake. That's me. That is me trying to convince myself that it tastes good. But what happens is okay, option prices fluctuate. This is key. I think everybody gets that option prices fluctuate with the price of the stock, right? What a lot of people don't get is option prices fluctuate at a higher percentage based on the velocity of the stock price, meaning that if a stock suddenly jumps up $4 or $5, the premium in the option prices explode. Okay, they go way, way, way higher because it's like, oh gosh, what's going on in the stock? And so the guys who are writing options, they're having to take on more risk, so they're baking more premium into that. And that's a concept that a lot of beginning option traders don't get. They think that options are a fixed reflection of the underlying price of the stock, and they're not. So if there's a lot of activity that comes into play, the option price can explode based just on the premium. So if you go in there and you buy it, not only did you chase a stock, but you also bought an option whose price, exploded relative to the underlying because of implied volatility, blah, 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 all right? Dave, the crappy part is when something goes sideways and your option continues losing value. Yeah, and that's where pinning comes in, and that's why we're going to talk about pinning, because that's when you actually want a stock to move sideways. But yeah, it does blow. Gary's asking, I've never traded futures options. Are they very liquid? Some are and some aren't. Futures options are tricky because there's not really a clean electronic way to trade them. They're more, the S&P, the E-mini options are actually fairly liquid. 98% of my options trading is done on equities. All right, so do you guys understand that basic concept? So it's we'll talk more about implied volatility here. I'm not going to go over all this. I'm assuming you guys understand in the money and out of the money. If not, we'll go over that quickly. The Greeks, you don't really need to know the Greeks. The main thing you do need to know, though, is the delta, which is this first one. And a lot of times when I say I'm doing a swing trade, I'll say I want a delta 70 option. What that means is an option that delta 70 means that if the underlying stock moves $1, then the option will move 70 cents. Okay, so that's a delta of 70. And that's typically 1 or 2 strikes in the money. And those are typically my favorite pure directional options to buy, although there's times when you can buy out of the money, and I'll go over that too. The gamma, you don't really need to understand that right now. Time decay, essentially the price of the option is going to just equal the price, the intrinsic value of the stock the closer you get to expiration. So if you own a $240 call and Apple at expiration is $245, well then your option is worth exactly $5. There's no more premium, And conversely, if you owned a $250 call and Apple closes at expiration at $245, your option is worth $0 because there's no time left. So all the premium's gone. All right. So that's what you want to understand. And you're fighting time decay. So when you buy out of the money options, you just have to be right. Okay. And that's the thing about it. All right. Theta and Vega, you don't need to worry about it right now. But implied volatility is important, and there are some specific plays you can do on implied volatility that are pretty awesome. But one of the most important secrets for pulling profits out of the markets on a regular basis is called implied volatility. Implied volatility is a computed value that has to do with the option itself rather than the underlying asset, okay? And that is the whole key right there. Implied volatility has to do with the option itself rather than the underlying asset, all right? So, and what will happen here is, in fact, I'll get a chart here for you guys, and let's do Apple. Let's look at Apple on a daily chart, and we're going to look at implied volatility on this, okay? And we'll just go to Insert Analysis Technique, and we're going to go to, if I can find it, implied volatility, all options. And then we're going to do implied volatility, one option. Oh, that's not what I want. I want the implied volatility rate of change. Actually, just the oscillator. Okay. And in this case, so here's the main thing with this and why this is important. When you see a situation like this, okay, here's where so many people get hosed. Let me get the drawing tools here. Okay, cool. So, now, I'll show you the right way to buy an option and the wrong way to buy an option. The wrong way to buy an option is you sit there and you watch Apple rallying and rallying and rallying and rallying, and you get excited, and you buy call options here. The problem is you bought them when the implied volatility has spiked. So here's the thing with this. If Apple goes down, obviously you're going to lose money. But Apple could go sideways, or it could go up slowly, and you'll still lose money. Okay? You guys understand that? It could go sideways or up slowly, and you would still lose money because the implied volatility spiked. As the implied volatility comes back down here, that means that the price of the option gets more in alignment. Okay? So that's so critical. The perfect way to buy swing trading options, and again, we're going to talk more about pinning, but this will help, is you get something like a squeeze here, and look at this. Implied volatility is really, really low. Okay? And you can see the implied volatility oscillator here is really, really low. That's golden because not only are you buying the option on the underlying stock before the underlying stock is going to move, but you're also buying it when the implied volatility is low. The double whammy here for when you buy an option at this price is not only are you benefiting from the rise in the price of the underlying, but you're also getting an extra kicker because implied volatility is kicking up, okay? This is like the best of both worlds, and if you're swing trading options, this is the perfect storm for you, okay? So just kind of remember that. You want to be a buyer when volatility is low, and then sell those options when volatility is high, okay? Now, this brings us to another point. The next point on this is, and this gets us into pinning, is, yeah, so in this case, okay, let's go, so, you know, Apple is at $340 right here, and you see that you've got a squeeze. So you buy the $335 calls, okay, and, you know, the stock goes up, and then you sell them, okay? So you make a profit not only because the stock went up, but you actually got a little kicker, okay? And that's what I love on options trading is when you get those kickers, because had implied volatility stayed low, then, you know, maybe your option would have gone from, let's call it from $6, you know, to $10. But because implied volatility spiked up, what's happening, the reality of it is your option's going from $6 to like $12, right? And that's what the implied volatility does. Had the implied volatility not changed, then your option would only be worth about $10. But because the implied volatility got higher, the premium expanded, and the price of the option expanded as well, all right? So when you buy low volatility and sell high volatility, that actually works out very, very good for you as a trader. But if you were watching this and you're like, oh my God, I got to buy some Apple, okay, and you bought this at 12, you are hosed for a number of reasons. Again, because at this point, the stock could actually go higher slowly, and because implied volatility is falling, you could lose money, okay? And that's where the devil's work of options comes into play, because that is so, so frustrating. And I used to get so frustrated at that when I used to trade in the beginning. Okay, so let me see what questions you guys have. Are these on an intraday chart or daily only? Daily only, Lee. They're only for daily. And does the TradeStation volume indicators also work for puts? Yeah, so this is all, doesn't matter. This is for all options, calls and puts. When implied volatility goes higher, it raises the price of both calls and puts. All right? So the other side of this coin then is this. And this is where the pinning comes into play. And this is why I love pinning. Is, you know, in a situation like this, okay, let's use the same example again. So, you know, you got the squeeze, the price moves up, and implied volatility spikes up. Well, guess what? There's an opportunity here to sell out of the money options. Okay, and this is an awesome, this is a great setup. So maybe you know what, the price here is like $350. So you can start selling like the $360 calls. Because what's going to happen in a situation like this is remember, if the stock goes, if you sell the $360 out of the money calls here with high implied volatility, if the stock goes down, you make money. If the stock goes sideways, you make money. And if the stock goes up slowly, you make money. Okay? That's the beauty of it. You know, if the stock just explodes higher, you know, then these things are going to continue to appreciate, and you can lose money. Okay, that's what. So you don't want to stand in front of that. Now, most of the time, selling naked calls entails the most risk you could ever take in trading options. So what happens then is instead of selling the naked calls, what you do in a situation like this is, if you want to take advantage of this, because it's a sweet trade to take advantage of, is that you go in and say, all right, I'm going to buy a $340 call that has a delta of at least 70, okay? So back to that 70 delta. And then you're going to sell the $360 call, okay? And that's got like a a delta of like 20, right? So you buy a $340 call, and then you sell the $360 call. And then what happens in this situation, in a perfect world, is that if the stock trades sideways or slightly higher, then, you know, maybe you make a little bit of money on this call, but what happens is you collect the entire premium of this one. You know, the poor bastard who chased that, and maybe he paid $4 for that option, the option expires worthless, and that's what you keep. The reason you're buying the $340 call is in case the stock explodes higher, okay? And in this case, this is called a vertical. If the stock explodes higher, you actually still make money, okay? Because you still keep the spread. So that's kind of the basics there of options 101. And then what I want to do is get into specific pinning plays. All right. Now the 360, 365 vertical, that's not a trade we'd do today. Okay. The trade we want to do today. So okay, based on this, now pinning we pin tomorrow, right? We close tomorrow. So based on what I just talked about here, what would you guys be thinking of doing here? Let's see how much you guys have soaked in here. Okay, let's do. So now we're just going to zoom in here. And so now, okay, so there's a couple of things here. So first of all, if we were going to do that right now, options, monthly options, and tomorrow, if we were going to do a pin here, what do you guys think? Now, some of you may not know what pinning means, but we'll talk about that here in a second too. Let me bring up Apple. And this might be a little tricky to see. What I want to do here is on this, and to show you, and I did this one yesterday, just like one contract, just to kind of show you guys, is what we're looking at here is open interest, okay? And this will all tie together. But what we're looking at here is what happens is these larger stocks that trade volume, okay? What happens is they tend to close at the strike price that has the largest open interest. All right? Okay, it's not letting me draw on this. I can't draw on the Java screen. Okay, that's fine. So you can see right here it's 24,000 right there, right? So, and that's at the 340 strike. And on the put side, open interest at the 340 is 20,000. So you can add those up, and that's about 44,000. All right? Well, that's bigger. That's 44,000 open interest. That's bigger than the other strike prices. Why is that important? That's important because mostly the people that are selling options are funds, okay? They're selling the options to suckers. Like, what will happen on something like this is, I mean, look at this. The $340 calls are $2, and they expire tomorrow, and Apple's at $341. So it's got $1 premium. So you could sell this, okay, and if this closes at $340 tomorrow, you collect that entire $2. It expires worthless. You could even sell the $345 calls. They're at 27 cents. It's a very, very high probability that we're going to close below 345, although stranger things have happened. But you could collect that entire premium. So what I've done here is, I did this yesterday, is bought one of the $335 calls. Okay, and you can see, and I just did one contract because it's like I knew I was going to be teaching today, and I've done, I think it was the last webinar that you guys were at. I actually did a 1,000 contract pin on JP Morgan. For Apple, it's usually anywhere from like, maybe, it's closer to like 50 contracts or 75 contracts, depending on if I'm doing verticals or ratios. But, what we're looking at here is, the one that I bought, the $335 one right now is up $48, okay? And then the one I sold yesterday is at $18. And what that means is that the stock has appreciated. So my $335 call is making money. And I actually sold that $340 call yesterday when the stock was around $340.50. But the premium has come down so far, even though the stock price has advanced, and I'm making money on it. All right. Well, what I think is going to happen based on this open interest is that tomorrow that Apple will get pinned at $340, and so we want to find is the best way to make money on that. And the best way to make money on that right now is to buy the $335 call and to sell the $340, all right? And so let's actually do that here. I want to start adding some more contracts. This is the time that we want to start doing it. So let's erase. So what you can do here now, there's a couple things. So then you can come over here, and we're going to go to vertical, all right? And the 335, 340, it's at $4.29. So you're going to come over here, and we're going to do a buy a vertical. And you can just double check. It says buy the $335 call, then we're going to sell the $340 call. I actually don't want to do 100 contracts on this. You can relax a little bit and do 10. And we'll just kind of split the difference here. Hit send. And now the order is working. We'll see if we get filled. Okay, Lee, have a good one. Okay, I'm not getting filled. So we're just going to work this order here a little bit. I'm not getting filled right now. That's an example. So what we're going to look at here is we're going to go through a couple stocks. We're going to look at this high open interest. Now, a couple of things to understand here. The stock has a high probability of, and it doesn't actually have to close right at 340, but has a high probability of like hanging out around 340 for a lot of tomorrow. And where you're going to get the biggest bang for your buck is tomorrow morning, because on these options that you sell, the premium is going to decline by a third, okay, by 33%. It's the largest drop in premium that ever happens during an option's life. It's the Thursday close to the Friday open of options expiration. You're going to lose a third of the premium, all right? So if you buy that $340 call, you're already against the gun right away, because that's going to lose a third of its value at the open the next morning. What you're banking on is, if you're a buyer, is that Apple rallies a couple of bucks very, very quickly at the open. And as a seller, what you're looking at is that Apple opens flat to slightly down, and that premium just evaporates, all right? And that's where you collect. Now, okay, so it brings up a good point. So the other question is well, couldn't you do a $345 put and a $340? You could buy a $345 put. Here, let's go back over here. You can look at this and say, okay, well, couldn't I do if you're looking at it to pin at 340, couldn't I buy the $345 put and sell the $340 put? You could, but look over here at the calls. The premium's a little better, all right? It also just kind of depends on kind of, and that part it can be a little tricky, but I'll show you just a couple of things you can do at it. In fact, let's actually look at a clean chart here. So here's a price chart of Apple. And what you can do, and this is helpful, especially if you're newer to this, is just draw horizontal lines at the strike prices. All right, so you got $345, which is about right there. And then you got $340, which is there. And then $335, which is about right there, okay? So now you've got the strike prices. Trend-wise, I mean, we had a big sell-off, right? Now we're kind of bouncing back. And what you're looking at is, remember, because the open interest is so high here, you're looking at this as an acting as a magnet. All right? And what that means is, that if Apple gets up here, that we would actually look for it to be attracted. Okay, why is it doing that? erasing itself. Why is it erasing itself? Pen. All right, let me try that again. So what we're expecting here, oh, the screen has to be frozen? Okay. So what we're looking at here is if Apple could rally up here, we'd look for it to head back lower, okay? Or if Apple fell down here, then we'd look for it to come back up. So at this point, at this point, what I'm looking at here is that you're looking at, okay, if Apple actually really takes off, what's the chance, okay? What's the chance that it could take off and rally up here versus rally down here, okay? And that's the question in the day that you have. Here's how I deal with that, is then you can just kind of look at an intraday chart. And let's go to, insert analysis technique. And whatever you want to use, you can use TTM trends, or like a C-wave is pretty good on this. And you kind of look at the C-wave, and so you can see here that the C-wave is crossing higher, and that's a buy signal. So just based on that, and that kind of gives you a little bit of an edge, is that the chances are that if it doesn't close at this strike, okay, then it's going to close at this strike, unless there's some news or something like that. Okay. So again, if for some reason it doesn't close here, then based on that, it's got actually a decent chance of rallying up to this level. So based on that, then, if you're trying to figure out which one's to buy, so in that case, if you bought this put, okay, say you bought the $345 put and you sold this one, then in this scenario, you would lose money, okay? Now, if it closed at the strike that we think it's going to strike, that we're going to close at, you'd make money. But if for some reason it went crazy and rallied, you'd lose money, okay? So what I'm looking at is like, well, the C-wave's above zero here. We had this big kind of a, dip down. So, either we're going to close at 340 or we're going to rally up to 345. So how could I make money in either one of those scenarios? Well, you buy, in that case, and you buy the $335 call and you sell the $340 call. Because if you trade sideways, you're going to make money. Or if you go to this strike price, you're still going to make money, okay? In this case, you're going to make the spread. And that's very important to understand, is that, Apple could go up 20 points tomorrow and you'd still make money. All right? So does that make sense? Now, if you're a beginner, this is probably might be a little over your head. That's okay. If you're more experienced, hopefully it's like, oh, cool, thanks for sharing. Okay, so Rick has a good question. So you're risking $4 to make $1. So no, you're going to have stop losses as well. So if we're doing this, let's come back over here. That's the other part of it. And a lot of times what drives me nuts is a lot of options courses, they just assume that you're going to hold everything in expiration, which is insane. It's called money management. So in this case, if we buy the $335 call, okay, and we sell the $340 call, we want to know what our risk is. Do we risk the entire $4? Because if it comes down here, all right, you're going to lose all of this money, okay, but you're going to make all of this money, but you're going to end up with a loss, okay, all right? So the next part of this is that once you establish a vertical, you got to see how much you're going to risk, okay? And usually it's, you're usually looking at about a 2-to-1. So in this case, if it's down about $2, meaning if it drops to about 300, a little below 338, you want to cut it loose, right? You don't want to risk having the move come all the way down. So that's the thing too, is you do have a stop loss in place. Yeah. So and for those of you that are swimmers, the Thinkorswim users, you can jump into the analysis tab there. I mean, I profess that I just kind of do all this in my head. I don't use that tool very much. Just because I've done it so long manually, but it's an awesome tool. I'm actually learning more and more how to use it. But for those of you that haven't done this long enough, you can actually just plug it into the TOS platform, and it'll show you exactly what your risk is and how much you can make and stuff like that too. All right. All right. Question from Neil. Do you have an opinion of what direction Apple is going to go before you choose the option and strike prices? And is the call or put open interest more important depending on your opinion of where Apple is going up or down? Okay. So Neil, the first thing about options pinning is the most important thing is open interest. Think of open interest as a magnet. All right. Now, it doesn't mean it always works. It just works a lot. And the nice thing is, if it doesn't always work, you can actually generally still make money. So, in this case, I look at this and say, okay, it looks like Apple is going to have a little bit of more of a bias on the upside, okay? What that means for me is I'm not looking to buy this put and then sell this put, okay? What I want to do is, I want to buy the in the money and then sell this one. You could also buy this one. You could also buy the 340 and sell the 345. The only problem with that is these aren't really going for much, okay? The other thing you could do is if your analysis is saying, wow, the strike price up here is actually the highest, that actually gets a lot of fun because then you could buy the in-the-money calls, all right, and then wait for a push to this level, and when it does push that level, then you sell the options, okay, because you can leg into that. That's a beautiful thing when it can work out like that, okay? Now, I never do the reverse because it's actually so risky to sell the options first and have them naked. But what's nice like this is you can buy the option, you're making money on the option, and then, people, we get close to $345, and now, these things are selling for like $2 a piece, boom, you just sell them, expire worthless, done. And those are beautiful trades when they set up like that. Okay, question from Ken. With Apple at $341, could you buy next week's $335 call, which is available today, and sell this week's $340 call? Absolutely. Absolutely, Ken. And it looks like I just got filled on some of, let me see here. Okay, I got one contract, so I'm still bidding for 9 more. So for those of you that are doing this trade with me, I just want to keep you posted on that. And by the way, this is something we plan to hold overnight. Oh, now I got to, let's see. Okay, so does everybody understand Apple? Because what I want to do now is we're going to look at another stock. I'm going to have you guys tell me what to do. Oh, what is my fill price? My fill price on that one. Was it $4.21? $4.28. All right. So let's look at another one. So one favorite of mine, and one I haven't done yet, is Citibank. But we'll look at that one last because that's a new one for me. But JP Morgan, believe it or not, is actually one of my favorite ones to do. And a lot of it is just because it's so freaking liquid. And let's go. I'm just trying to see this so we can actually see the current price, but see the options. So now, JP Morgan's at $43.94, okay? So, all right. So the $43 call, let's look at open interest. So this is a little strange, to be honest. The open interest on the call side is extremely high at 46. I seriously doubt we're going to 46, all right? Now, the open interest on the put side, the highest open interest is at 43. All right, so this picture isn't as clear as it usually is on JP Morgan, but let's take a look here. We're at 43.94. $44 call as an open interest of 14,000. That's not bad. All right, so if you start adding these up, the $44 strike has the largest open interest. Okay, so very possible that we close there. So the trade you could do here is that you buy the $43 call and you sell the 44. Now, the premium here isn't that great on the $44 one. You're essentially, you can go over here and say, all right, let's look at the vertical on that. And essentially what you're looking at is the vertical, of course, goes to $1, right? If it pins out, so you're looking at buying this for 82 cents, selling it for $1, and that's only 18 cents. Now it's not bad on something like this. You can actually do a lot of contracts on, but I'd want a little bit more of a kicker on that. So what I want to do here is actually something a little different. Is I actually would like to do is buy the $43 call and then wait to buy the $44 call later, possibly tomorrow. So it's a little trickier on that one, but let's, let's table that one for a second, and we'll kind of keep an eye on that one. It's what I do like to do, but it's kind of like it's almost already there. It's almost already pinned, which makes it a little, tricky. All right, so let's see. Now I want to look at Amazon. So if we go to Amazon, in fact, let's do make this so we can see it. So let's look at the weeklies here too. For Amazon, we're at $199. The $200 strike has by far the largest open interest on the call side, and on the put side, it's a little heavier below. The call side generally has more importance because that's a naked position, so there's more risk there, and that's the one that the hedge funds want to close out. There's actually, if you add them up, so 7 and 9 is 16, and then 12 and 4 essentially 16. So there's actually almost the same amount of open interest at 195, but it's blinding. That high number there is actually fairly blinding in terms of that. So I do like this one, the 195-200, and this is one that I think would be worth kind of legging into, where you could buy the 195 and then see if we could get a pop closer to 200, and then you sell the 200. Okay, because a lot of times you see that in the morning too, where you get that little pop trying to entice the suckers in to do that one too. All right, we'll get back to that one. Let's look at let's look at Netflix, see if there's anything standing out there. Nothing too interesting. The open interest isn't that high. Google is actually typically a good one, though. It's been a little crazy on Google. Let's see what. So Google open interest, and the stock's at 533. So remember, we're in between two strikes. The 535 has 8,000 contracts, twice as many as the nearer contracts. And on the put side, it's a little more negligible. So 535 actually looks pretty decent on that, and I actually like this one quite a bit. Now, in this case, you buy the 530 and sell the 535. That's actually fairly attractive as it stands right now. And, the 530, 535, essentially you're looking for it to go to $5, so you could buy it at 320, and you got the potential to make $1. So I like that one. So let's come over here. Let's buy vertical. And let's just do 10. Oops. And then what I do, you'll see there, so 288 and 310, we obviously want to buy it as low as possible. You usually have to kind of split the difference. So let's see if we can get them at 297. All right, so I'm going to place a All right, so I was filled on that instantly. So that was easy. I think I just got the Apple ones too. Okay, so now we're working that. So now you can kind of get an idea. All right. So we've got the Google one. Again, remember we want Google to pin at $535, and now we're cooking with gas on that one. Question. Oh yeah, thanks, Lee. IBM's a good one. Do you take IV into consideration when pinning? Okay, so good question, and the answer is yes and no. The no part comes in is I don't take consideration when setting up the verticals. What I'm looking at and what I'm counting on is for an IV crush tomorrow morning. So high IV is good. High implied volatility is good to do this with because you want to see that implied volatility crush at the end of the day. And you can see right here the implied volatility. We'll go back here to single. In fact, let's go back to Apple. So for Apple, the implied volatility on the $335 call is 18%, which is not that high. The 340 is 14%, which is okay. What's nice is when you see a spike up to like 20 or 30, but it's already getting sucked out. Yesterday, when I sold that first $340 call, implied volatility was like at 25%, which was good. Now let's look at Google. So a little lower there. And let's go to Amazon. So look at Amazon. The implied volatility on Amazon is super high. So I'm intrigued by Amazon because I think we could sell these for $2. So what you can do is you can actually buy the $195 calls and then place a limit order to sell the $200 ones at $2. But we can see where we open tomorrow too. All right. Well, Dave, for the entire market, high is like 30%, and low is below like 15%. But it varies for individual stocks. And what's going to happen is if you look at Google or Baidu before earnings, implied volatility jumps up to like 60%. It's insane. That's why it's so hard to make money doing a straddle right before earnings because the implied volatility is so incredibly high, and then it just disappears right after earnings come out. But let's look at IBM too. Okay, if I can type it in correctly. Anybody trade LinkedIn today? Up $63.22. I'm pretty sure it doesn't have options on it. Anybody know the symbol for LinkedIn? Like LNKD or something? All right. So IBM, while the implied volatility is pretty high, that's nice. LKND, okay, we'll take. I'm sure that's not trading options. Blah, 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 blah. So we're at 170, 165. That's not. Meh. Let me see the vertical on that. Yeah, see the 165, 170 is already pretty high, so you only got about 40 cents of room there, but it's a good one. IBM's a good one. This would be one, again, where you could buy the 165, see if you could get a spike up to do that. Yeah, so usually I don't trade options on the first day. I'm kind of curious, so let's look at the stock. Man, whenever Facebook goes IPO, that'll be pretty interesting. So when did this open? So this opened the day. This reminds me back in the day when we'd trade IPOs at the open. So it opened, its first 1 minute bar had a high of $83.83, and then wow, that was a nice little move there. That's just like man, I'm totally taken back to the day when these stocks used to go public and stuff like that. That was always so much fun. Yeah, and it's I don't even know if you could short it right now. Like I don't know if there's stock available to short. Who could buy LinkedIn at $45? People who are like insiders who got the stock assigned. What happens is, the brokers like Goldman Sachs, they'll have however many shares at $45, and they get to flip them out of the open. That's why it's good to be on Wall Street. That's why they want to take these companies public.